when we talk about initial risk, actual risk, how you're always risking open profit, and this is a chapter where Al talks about it specifically. And he just talks about how if you look at any chart and think, if I had taken a long or a short here, and I would still be holding, like a swing size position, then you need to be entering the market at a position size that correlates to your stop loss, more or less, okay? Long story short, getting long or short equals staying long or short, okay? Open profit is your money. It's not other people's money or free money. It is always your money. If you make, if you have an open profit of 9 points and you go to break even, well, you lost 9 points, and that's just reality. And if you are unable to do that, buy or sell at the market, then you have one of two issues. You have no belief that you'd be holding the position, or you have an emotional issue that you need to correct. So here's an example, okay, and this was actually from yesterday's price action, and it's in this example we're talking about being short, So say you're looking throughout the day, and maybe you didn't take any of these entries up above, and then you see bar 24, 25, 26, 27, 28, whatever, and you're like, dang, I really need to be short because I believe that we're always in short, and the market's going to go down, maybe for a measured move or however you want to do it. So then I put this example here. If you normally trade 2 E-mini and you risk 10 points a trade maybe, and here you're going to enter around 43.45. Say you sold short bar 26 as it was going down. Well, you're at 43.45 and your stop is let's say 43.65 to make the math easy. So it's 20 points, okay? Well, in this example, you would just enter at half of your normal size, and the dollar amount risk is the same. And of course, you can always add on later, because as you can see, as the day went on, people would have killed you to have this kind of an entry. It's just at the time it feels wrong, But that's what Al is talking about when he says things like getting long or short is the same thing as staying long or short. If you sold 2 E-mini contracts, okay, here at the double top, maybe your scale is here, maybe it's a measured move breakout, whatever you want to call it. It's the same thing, whether you're holding here and you get out break even, or whether you sold here and you're holding all the way down here. It's all the same. So if you believe it's going to work, you probably should be in the market, just at a smaller size. That's it for chapter 11. So chapter 12 is pattern evolution. Essentially, what this is Al talks about how patterns take on different forms, and most of the time they work. It doesn't matter what you call them or whatever. When they work, they give you a minimum of a scalper's profit. And when they fail, they often yield a swing because traders are going to be trapped. But if the failure fails, essentially, and creates a new pattern, essentially you go all the way back to step 1, okay, where you just observe that pattern alone and you don't put a lot of stock into the previous one. So here you have double tops, bars 1, 7, double tops 17, what is it, 17, 18, 19, 20, 21, 22, 23, 17, 23. At a minimum, you get scalper's profit. Realistically, there's probably swing shorts, even though the signal is not that good. But yeah, it's at a minimum, you can expect a scalper's profit here. And I wanted to include a sell climax that ended up failing. You can call it a wedge. 1, pullback, 2, pullback, 3. You can call it a wedge. Call it a descending wedge. It doesn't matter what you call it. Most of the time, you expect 2 legs sideways to up. And on a sell climax, very common pattern to go back and test open of the day. Well, it didn't happen here. The bulls were stuffed at around the 50% pullback. So this pattern failed, so you ignore this now. Okay, maybe after bar 55 it's ignored, and a new pattern begins, and it's a bear micro channel. But just before I move on too much, you see how when the pattern failed, it's normally going to yield a swing. Well, you didn't get your 2-to-1 there. So back to the next slide. Trend lines and channels. This chapter is broken down into 2 parts. So it's pattern evolution, and then the second part is trend lines and channels. Trend lines contain price action. If you're a bull trend, the line goes below, bear above. And they're converging in wedges and most triangles, and they're divergent with expanding triangles. Most of the time, trend lines are going to set up with trend trades, and the opposite are going to be channel lines, right, where they're straight, diagonal, and roughly parallel, and it doesn't matter if they're up, down, or sideways. Bull channel, bear channel, or trading range. Channel lines are just trading ranges; they're just trending, or they're sideways, and they help set up counter trend trades. Okay. So let's look at this bull trend. You draw a trend line connecting the lows here. And I usually prefer 2 touches. Some people say 3, but I think 2 is good enough. And they set up with trend trades. And something that I think doesn't get talked about enough is false breakouts with these trend lines. And people who are really good at trend lines, they kind of instinctually know this, right? So you have this bull trend developed into a trading range, and then we broke out, but this trend line isn't invalidated. Even bar 68 doesn't invalidate it. You need, for a breakout to work, right, you need a breakout bar, which is bar 67. You need a follow-through bar, okay, which is bar 68. It's a good close, but then you have to retest it, which it did, and it followed through. But you need more than 1 bar here, I think. You need at least 2, maybe 3. And then you can wait to sell on a pullback, or you can sell small and scale in. But here, you just get outside up reversal bar, double bottom. It's a beautiful with trend setup. And you pretty much are immediately rewarded with a nice scalper's profit, potentially, your swing profit 2-to-1. Definitely get your 2-to-1 later. So it's these trend lines. It takes time to break, and if it's a bull trend, there always will be buyers below these trend lines. Okay, same thing in bear trends, which is the next slide. There's always going to be sellers above these trend lines. Okay, they're waiting to trap the eager bulls in this case, or in the previous case, the eager bears. They're waiting to trap them. And this is exactly what they did here. So, obviously with a bear trend, it's just the opposite. You draw the line above, connecting the highs. So the channels, trend channels, you have a sideways channel. It's just a trading range. You can see most breakouts are failing. So, this breakout fails, this breakout fails, this breakout fails. You have 1, 2, 3, 4, 5, 6, 7 breakouts failing. This one was what we saw with that bull channel line. I would consider this successful. But yeah, 7 breakouts failing, and then this one finally works. 7 out of 8. Not good odds. That's why the channel lines tend to create counter trend setups, because you could sell here, you could sell more betting on a bad breakout. You could buy here, sell, buy, sell, buy, sell, buy, sell. And a bull channel, again, it's just a it's just a trending trading range, okay? And the most common scenario in a bull channel is to break out bearish. Conversely, in a bear channel, most common scenario, break out bullish. They're just sideways trading ranges. That's all they are. So again, I set up counter trend trades. Ignore the middle line. That is just 50% of that range that I like to have. So you could just buy, sell, buy, sell, 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 buy. As long as you're willing to hold through it, you're fine. Sell, buy, sell, buy, sell. When you see a bar like well, this is the 2 days in one, so excuse me about that. So it's probably just sell, buy, sell, cover, because the day ends here. And then triangles. Expanding triangles, the lines diverge, so this is kind of an expanding triangle. Here, again, buy, sell, same thing. Triangles, regular triangles, the lines converge. This is a bull flag that failed. Most commonly, I see triangles from bull flags or tight trading ranges. Because even then, some people would call this like a channel. Maybe if they didn't start from here, they started from bar 8, they'd call it like a bear channel, which is fine. Both are right, and neither one is wrong. And the words of wisdom from Al. Well, the actual chapters were short again, so I really only have one. And I need to take this advice as well. When the market has a clear always in position, you need to participate. I sold Friday. This is Friday's action. I sold here. No, it was here for a scalp, and ended up buying. I think I bought maybe this bar as it was going up, failed, and then I bought here again, betting on a trading range, and I got it. So I scalped that once again, and it ended up making about 9 points. I think it was actually right on the dot 9 points with these trades, which is good. It's a good day. I'm not going to complain about it, but if I want to be better, maybe I should have maybe sold the close of bar 24, or maybe the close of bar 25, 26, something like that. Probably 26 would be the safest bet. Sold small, stop loss up here, and then I can add on, at a break, maybe bar 40, bar 41, something like that. Maybe I could have been up 20 points instead of 9, for example. But yeah, that is it. I don't see any questions in the Discord, so I will stop streaming and get it uploaded. See you guys later.